Okay, these are my notes from the 2006, 2007, and 2008 Berkshire Hathaway meetings. Prior to buying See's Candy in 72, we looked at price-to-book ratios instead of intangible assets, which can be more valuable than tangible assets. So that was a cheap companies versus a good companies dichotomy, which they changed. In, out, and too hard. A lot of things end up in the too hard pile, and it doesn't bother us. We don't have to be able to do everything well. You go to the Olympics and you run the 100-meter well, you don't have to throw the shot put. Some other guy can throw the shot put, and you'll still get a gold medal if you run the 100-meter fast enough. So we try to stay within the circle of competence. Find your best opportunity and then measure all your other opportunities against that to find your opportunity cost. Then go with the best opportunity that's right in front of you. That's the best way to manage small amounts of money. Concentrate on the best. Most won't find many things that are equally good, said Charlie Munger. Then Buffett said, a market is there to serve you, not instruct you. The market doesn't tell us anything. At the end of the 2006 meeting, Buffett said he could short and be accurate, but it might go up 5 times beforehand, and it would be too stressful. So that's why he doesn't short. Warren said that gambling is a tax on ignorance. I don't think there's anything like reading to become a better investor, then jump in the water with real money. The past is only useful to you in the extent to which it gives you insights into the future. One of the reasons we've been able to do pretty well is that we early recognized that very smart people do very dumb things, and we tried to figure out why, and we also wanted to know who so we could avoid them, said Charlie Munger. Then Warren said, the best hedge against inflation is your own earning power. Second best is to own a wonderful business, not a metals business necessarily. The best is one that needs little capital and flexibility in price. 2008, how to avoid investing like the crowd. Read The Intelligent Investor, especially chapters 8 and 20, and you won't behave like a lemming, and you can't get a bad result. There are 3 big lessons which relate to your attitude towards stocks generally. 1, you think of the stocks as parts of a business. 2, your attitude toward the market, which is that you use it to serve you and not instruct you. And 3, the idea of a margin of safety, of always leaving some extra room, said Buffett. How to hire good managers? We cheat. We buy good businesses that already have good managers, and rather than hire, try to keep them. But look for the people with passion and who are good communicators. Investment success is not about difficult math, but depends on buying into the right businesses at the right price. And you have to know how to value businesses, and you have to have an attitude that divorces you from being influenced by the market. Again, constantly stressing that the market should not instruct you, but serve you. On giving, on the pitfalls of giving, if you have an extreme political ideology, whether the left or the right, you're very likely to make a lot of dumb charitable gifts, said Charlie Munger. Warren said that Berkshire is limited in its investments as it gets bigger, so it won't perform like it used to. If you're working with small amounts of cash, you may have something better to do with your money than Berkshire. If you're working with small amounts of money and willing to put in significant amounts of time and examine thousands of securities, you will find things that are more intelligent to buy than Berkshire. We don't think it's the most attractive investment in the world in terms of what you can find if you're willing to go through thousands of possibilities, which is what Charlie and I used to do many years ago. What we really like at Berkshire is buying good-sized to very large first-class businesses with first-class management and just sitting there, because the nice thing about that is you don't have to go from flower to flower. You can just sit there and watch them produce more and more every year to give you capital, and you can buy more businesses. That's a nice formula. It's a formula that I think will work for us, but it won't produce returns like we had in the past, said Warren. We don't hedge currencies. We have businesses like Coke that are already spread out around the globe, so there's no need to. He said, you want to buy a company that even an idiot can run because sooner or later one will. On position size or percentage of holdings, he said, I've had 75% in one stock. There are some things, you'll see things, it would be a mistake working with smaller sums not to have half your net worth in. There will be some extraordinary things happen in a lifetime where you can put 75% of your net worth or something like that. They won't be talking about it on TV. The problem has been guys who put 500% of their net worth in, like long-term capital management. Elite business schools, etc., wrongly teach the whole secret of investment is diversification. That's the mantra. They've got it exactly back-assward. The whole secret of investment is to find places where it's safe and wise to non-diversify. It's just that simple. Diversification is for the know-nothing investor. It's not for the professional, said Charlie Munger. There's nothing wrong with a know-nothing investor practicing it. It's exactly what they should practice. It's exactly what a good professional should not practice. But there's no contradiction in that. A know-nothing investor will get decent results as long as they know they're a know-nothing investor. Diversify as to the time they purchase their equities and as to the equities they purchase. That's crazy for somebody that really knows what they're doing, and you will find opportunities that if you put 20% of your net worth in it, you've wasted the opportunity of a lifetime in terms of not really loading up. We've had the chance to do that in the past when we were working with small sums of money, said Warren. Someone asked why Warren bought PetroChina after only looking at the annual report but not doing any further due diligence like talking to management. He answered that the company was selling for a fraction of what it was worth, so it wouldn't have mattered. It was glaringly, obviously undervalued, and doing a lot of further due diligence would have slowed him down, delayed him, etc. But if a company was not undervalued glaringly, he might do it. Question that somebody asked. What's the number of stocks you're willing to consider if the market drops to give good values? So this is about saying no to things, saying no to many things. If we can't make a decision in 5 minutes, we're not going to make it in 5 months with more info. If I look at a company and there's a significant difference between price and value, we move right then, said Warren. We can make a lot of decisions about a lot of things very fast and very easily, and we're unusual in that respect. And the reason we're able to do that is there's such an enormous other lot of things that we won't allow ourselves to think about at all. It's just that simple. I have a little phrase when people make pitches to me, and halfway through the first sentence I say, we don't do startups. They just don't exist. Well, if you blot out startups, there's a whole layer of complexity that goes out of your life. And we've got other little blotter out systems, and using those we finally find out what remains is still pretty large territory that we can handle, said Charlie Munger. Warren said there's an awful lot of giveaways in the first sentence or two that people throw out that we just know we aren't, that it isn't going to work. We waste a lot of time, but we waste it on things we want to waste our time on. We're very selective about that, and then we're good at it. We waste a lot of time, but we're not going to waste it on things we don't want to waste it on. Someone asked him about regional banks. He said the size of a bank shouldn't matter. Only the bankers running it, small or large, should both have opportunities. On dividends, Warren said he's for dividends, but the test is whether a company can create more than $1 for every dollar they invest. If they can, then they should not pay a dividend. See's Candy should pay a dividend because they can't create anything new with the extra cash. Berkshire would like to receive their dividends so they can reinvest it more efficiently than See's Candy can. On reading, Charlie Munger said, I was put together by nature to learn from reading. If some guy's talking to me, he's telling me something I don't know, I don't want to know, I already know, or he's doing it too slow or too fast. And reading, I can learn what I want at the speed that works, and for me, reading is what works for my nature. And to all of you who are at all like me, I say welcome. It's a nice fraternity. My father did more of his share of the work and took more of his share of the risk. If you just keep picking up a lot of books, you'll learn a lot. If you read 20 books on a subject, that you've got an interest in, you're going to learn one hell of a lot. You don't know which one you're going to learn it in, though, said Warren Buffett.